Yeah, I thought I lost. Okay, thanks everyone. I'll make a start then, and see if there's any more people coming in. Give me a sec. Okay. See my screen? Oops, I think.
Yes,
Hello?
sir.
Yep.
Cool. Okay. Okay. Thank you guys for coming to today's SIP community call. And today we're going to talk about stacks mining decentralization. Matty has 3 proposals. So I'll let him go through the main topic in a bit. So really appreciate everyone's time. So yes, like I said, there's 3 stacks mining proposals. And I just want to let everybody know that this didn't come out of thin air. In fact, we found this process really useful by starting a conversation on Stacks Forum. There's been a really comprehensive discussion on Stacks Forum. And from that, people were able to get together, have a real-time call to hash things out a bit more. And there's been a couple of occasions where they had a real-time Zoom call, and that really helped, I think, in terms of getting the idea from idea to refined proposal like now. So I think it's just worth sort of pointing out. I think that's a really good example of how to use the Stacks Forum in order to help you form, start an idea, start a discussion, and then get to the, and become a draft SIP, or at least a proposal, and then we can discuss it further. So yeah, really, really good sort of process. Just want to highlight. Yeah, lucky to have Matty this week. So just for those who hasn't been here before, I think most of you have, looking around, but just a very quick going over what we're here for. Here we update everybody on where the SIPs are, whether it's from the brainstorm stage or to the late stage. And here you can share your idea, share your proposal, and here is also opportunity to collaborate. And we can host, like last 2 weeks ago, we hosted a Bitcoin derivation path talk where different people were able to hash things out on that topic. So yeah, here is a great place. Any SIP related stuff you can find here. So I'll give everybody a SIP update, but just before that, I will just quickly go over what's a SIP. A SIP is a proposal, a stacks improvement proposal, and it's a document that lives on GitHub. But essentially, it goes. It's a way to improve stacks core technology, going from idea to a draft SIP, and going all the way through all the vetting process and reviews to become ratified. So that's a sort of overall process, and you can see here from idea to ratification. So just a quick top level overview of the late stage SIPs. So from the accepted stage, which is a little bit earlier, like here, that's due to be reviewed by the technical caps, and then it will get reviewed by steering committee. And we've got 7 people now in the technical cap. So I'm hoping at some point they can look at it, but I need to sort of notch them and sort of activate them. But yeah, like that will get looked at. It's a semi-fungible token standard by Marvin. So yeah, hoping they can even come on and have a talk about that one day. So the later ones, the activation in progress stage, which is down here. So SIP 16, I believe the activation criteria has been met. At least we found quite a few different contracts that have basically, I think basically that criteria require 10 deployment. And I think we found 10 contracts that has that metadata standard SIP16. Yeah. No. Yeah, so it's just waiting to be reviewed by steering committee. Oh no, as long as that's all checked out, that should be verified.
Yeah, I
As far
think it's good. There were a few more that were discovered. I think we had 9, and one of them was just a pointer to a transaction on the Explorer without the actual metadata.
Oh, right. So we need to find that metadata link URL.
Yeah, because the pointer was just to the smart contract, not to the instantiation of the NFT.
I think I know which one. I'll ask Dartman to maybe figure that out. He's been super helpful.
Oh wait, yeah, it looks like we do have a bunch actually. Darwin just dropped a bunch a couple days ago.
Yeah, and that as long as all checked out, that can go to ratified.
Yep, I think I can just do that right now actually.
Oh, okay, there you go. Here's good for that. So yeah, come on guys, to this call, you can get your stuff ratified quicker. Yeah, so the next one, the 618 is, I believe, is the signed message thing, which is live in Hero Wallet. But the next one, 619, that one I'm asking if Rafael can come on and actually talk about his SIP. So I think they're doing some indexing stuff. They're creating one of the indexers and stuff. So yeah, so all those stuff are in progress. And just another big shout out to Dartman. He's been great in helping find SIP16 contract. Yeah, some early stage stuff from Fridger, the authentication protocol stuff, so to do with IDs and stuff. So we'll get him to come and talk as well about that. So yeah, some early stage stuff. If people want to come support that or utilize that stuff, please feel free. So there's GitHub issues, a couple of things I just want to point out. We're hiring, not hiring, but we are finding more steering committee, and we'll be adding names to that, and so are the caps. And just want to point out all previous weeks videos are now live, so you can go watch them. In the links are all in GitHub. There's all the meeting notes, all the useful resources links. So yeah, please use that resource. Some early stage stuff. There's a new one just came out fresh today. Safe token transfer standard that Marvin and Mike believe is from them. So they would like some comments. If you could have a look, that would be great. I believe it's an improvement to tidying things up and a bit of improvement to SIP9 and SIP10. Yeah, so they just published that, so would be great. It's on Stacks forum, and they've tweeted out as well. So yeah, just if you have a chance, would be great to take a look. I don't know if they're on this call. Yeah, okay, anyways, yeah, some derivation path stuff, some BNS stuff, some minor centralization stuff that we can talk about today, some early brainstorming stuff. So all these stuff, so all from Stacks forum. So this is a way to contribute towards the process by voicing your comments, voicing your thoughts, or if you have ideas or improvement. These are the ways that people can really help Stacks improve and really contribute directly in this way. And in other news, Hyperchain is being updated to subnets, and there's a really interesting node syncing thread, and nodes is super important for decentralization, so I hope people check it out. So yeah, that's the sort of all the SIP activities. And just want to point out, over here we actually talk about really important stuff such as Stacks 2.1, mining, the SIP process, the actual SIP process. If people, thinks there is room for improvement, like, please feel free to voice your opinion. We talked about Taproot improvement. We talked about caps. We talked about increased health, increased Bitcoiners participations. Yeah, so, and we'll have open discussions when the week we don't have topic. So please feel free, but there's always room at the end of each meeting to have open discussion as well. So yeah, you can come anytime and we talk about important stuff. So yeah, please join. So, I'll leave this till later. So yeah, I'll leave the floor to Maddie, if he wants to share a screen.
Sure, thanks, Zero. Yeah, let me do that. Looks like you need to stop sharing your screen. Okay,
Yeah.
cool. All right, can you guys see what I'm seeing?
Yep.
Okay, awesome. So, as a refresher, right, this is, as you can see, a continuation of a conversation that started a couple months ago. It's on the SIP forum board under, I don't have time to scroll all the way up actually, because it loads as you scroll, but it's under miner centralization. So anyone who wants to, catch up on this board or read the latest posts can go to forum.stacks.org, and it's the miner centralization thread. And basically, there have been a lot of discussions about how can we promote more decentralized mining, because if you guys might be aware, might recall, how do I get this out of the way? I did a report on mining, and it basically found that there are about, on average, or typically, I should say, 7 or so miners. Where is that? 7 miners, typically 7.3 miners typically. It takes about 3.7 miners to hit a 50% attack on stacks. So, it helps the security, it helps decentralization if there are more miners. And then also the other kind of, or possible reason of why there are not more miners is that it takes a lot of capital to get started. So it takes about 2 Bitcoin per cycle, which is 2,100 blocks, to break even, based on what miners are profitable at and based on what gas fees are. Because when you mine stacks, right, you have to send Bitcoin transactions, so you're paying a Bitcoin gas fee, just like you do if you're sending any other type or reason of a Bitcoin transaction. So there's a lot of theories about why there are not more miners and how we can improve the mining decentralization. And just to briefly summarize kind of the short list of things before we kind of take a slightly more detailed look at each, although I don't want to get too much in the weeds, because we could spend hours talking about this topic. There's roughly 3 schools of proposals that I've looked into and analyzed. The first one is this concept of dust mining. Munib brought this concept up. It works by basically reducing the capital requirements to mine. So instead of needing, 2 Bitcoin per cycle, which is at current prices, what, like 50,000 US dollars, quite a stretch of capital for most people. It reduces that capital requirements to mine. And so in the modeling I've done, we could expect maybe 30 more miners coming in from dust mining. We'll talk about that in a moment. So the advantages of dust mining are that it increases the number of miners, it promotes more mining activity, it provides potentially an on-ramp for people who start as dust miners and get comfortable with mining, get comfortable with the risks, get more familiar with it, and then convert from dust miners to quote unquote normal miners, or miners of how it currently works. The disadvantages, though, is that dust mining is essentially adding this separate, Munib uses the term bike lane, using this separate kind of lane that sets aside a fixed percentage of stacks blocks to be won by people who do dust mining. And by dust mining, it means sending transactions that are only Bitcoin gas fees. So instead of sending a transaction that needs to bid towards winning the block, you only send the Bitcoin gas fee, which all else equal can drastically reduce the actual amount of Bitcoin you need to spend each block. It can drastically reduce it, which is why it reduces the capital requirements to mine. The disadvantages, though, there is that because it's the separate bike lane, it's not actually contributing to the normal mining activity, the VRF commitments. So while it increases the total number of miners, and it potentially increases, people running full nodes and people like interested in mining and learning more about mining and who might become full miners in the future, it doesn't explicitly increase the number of full miners right now, and therefore it doesn't actually increase the number of miners to execute a 51% attack or a greater than 50% attack. And it slightly reduces stacking rewards as well, because all else equal, if people are mining with just gas, obviously that gas is going to Bitcoin miners, not to stackers of stacks. And so it either reduces stacking rewards, or you need to increase stacks inflation in the short term to kind of compensate for that. Or you can do some sliding bar in between, where you reduce stacking rewards a little and increase inflation a little, or vice versa. So we can get into dust mining in a second, looking at the more details of the expected outcomes. But I just want to first cover the other two proposals, schools of thought at a high level. The next one is basically the concept that larger miners have larger profit margins than smaller miners. So this is important to think about, right? So it's not saying that larger miners in aggregate have more profit than smaller miners. You would of course expect that. But what it is saying is that even on a profit margin percentage basis, larger miners have larger profit margins as a percentage than smaller miners, meaning that they have an advantage over smaller miners beyond just size. Or beyond just aggregate profit, right? They're more profitable per unit of investment the larger you get. And so this makes it kind of difficult, at least in theory, for smaller miners to get started because they're playing on an unlevel playing field. There are various different ways to theoretically level this playing field. They all essentially have to do with limiting or quote unquote punishing larger miners' chance of winning the block. So for example, you could say the most you're allowed to put towards the VRF function, right? The random function that determines who wins the block is X sats a block. Or you could say that as you contribute more, we take the square root of it, right? So if I contribute 10 sats, I get a certain share. If I contribute 100 sats, I get a diminishing share, right? So it punishes, you become less efficient as you get bigger, which counters the inherent natural state of getting more efficient when you're bigger. Another way to do this is to probably the most elegant and the least gameable way that was discussed in the forum was to simply impose that you must pay a minimum percentage of your total commit as gas. What does this mean? It means, for example, if I want to bid 100 sats towards potentially winning the block, I must pay at least X% of that. Let's say X is 10%, just for simplicity. If I want to bid 100 sats, I must pay 10 sats as gas fees. So that forces everyone, whether you're large or small, to be paying the same percentage cost on gas fees, which levels the profit margin between large and small miners. Unfortunately, when we look at the analysis, this has almost no expected practical impact in attracting additional miners. What it does do is for existing miners, people who are already mining, it makes smaller miners more competitive with larger miners. So maybe it could, maybe the analysis kind of understates it a bit, like maybe some smaller miners who might drop out in the future would stay in longer or permanently if this were implemented, but it largely just makes a difference to existing miners. It doesn't really create much room for new miners to join, because the key disadvantage is it actually does absolutely nothing to reduce the capital requirements to start mining in the first place, right? It doesn't lead to any lower costs to get started. And in fact, depending on what X is set to, it could even increase the costs that people might have to pay to get started. And so it's expected to have very little impact to attracting new miners, even though in the future, it might be more important to level the playing field to keep, smaller miners who have joined going for the long term and level the playing field for existing miners. So this is not necessarily a bad proposal, but it doesn't necessarily fix the current problem that we're focusing on prioritizing. Finally, there's one other approach, thought process, which is basically counting a percentage of the gas fees towards VRF. You can almost think of this as like blending dust mining with the current way mining works. So for example, let's say I don't have a bunch of sats to bid. I'm a small miner. I would usually have to be bidding 100 sats per block in the VRF to try to win, and pay 10 sats per Bitcoin transaction in gas fees. So every block I have to spend 110 sats. What this is saying is that maybe we could count a percent of your gas fees towards the VRF function. So let's just keep the math simple. Let's just say X is 50%. That means that if I bid 100 towards the VRF and I pay 10% in gas, my total commitment is 100 plus 50% times my gas fees. So 105 in this case. So what does that do? Well, it makes it easier for me to get started as a small miner because I could potentially mine only with gas, or I could mine with, more gas and just a smaller bid. It basically reduces the amount of sats I'm wasting on gas when I'm a small miner. Because if I'm a very small miner where I'm paying 10 sats in gas to make a 10 sat bid, right? And we're refunding 100% of my sats go to VRF, then I can just bid 10 gas fees, sats and gas fees, and save 50%. My capital requirements are now 50% lower to get the same exact probability of winning, or the same contribution towards VRF. So that's in theory how it works and why it benefits. So it reduces the capital requirements to mine, similar to dust mining. Now, it's very difficult or impossible to kind of extrapolate from existing data how many new miners this would attract, because nothing in the current data, nothing in the behavior of existing miners really describes like how many theoretical miners are sitting out there waiting to mine if it were less capital intensive to do so. We can make some like really rough estimates, but I don't feel comfortable necessarily like unlike the other two proposals where we can analyze the data and see like how do existing miners respond to these type of changes. We can't really do this in this case because it's a question of like, if we change this, will new miners come in explicitly? So it's hard to model exactly the expected additional miners. The advantages though are that it reduces the initial capital required to get mining, but there are some additional disadvantages here that are pretty important to think about, definitely worth thinking about seriously before rushing into this. Because if too much percentage gas goes to VRF and a Bitcoin miner has too much of the hash power of Bitcoin mining, then that miner can essentially mine stacks for much more cheaply, like virtually free compared to other miners. So for example, just in the extreme case, to show that this can be abused, let's say that 100% of gas fees count towards VRF, and the largest Bitcoin miner has 30% of the hash power of Bitcoin. That means that Bitcoin miner is winning about, let's say they have a third of Bitcoin hash power. So they're winning every 1 out of 3 Bitcoin blocks. Now, when they win a Bitcoin block, they can just say, hey, I'm now going to include my transaction to bid on winning stacks, to mine stacks, right? And maybe they're going to even exclude everybody else's transaction to do so because they're making the Bitcoin block so they can determine what's included in the Bitcoin block. So 33% of the time, 1 out of every 3 blocks, they can make themselves the only bid, and they get the gas fees that they spend on that bid to win stacks back, right? Because they're mining the Bitcoin block, so they're the one earning the Bitcoin gas fees. So if the VRF percentage gets too high and or a Bitcoin miner gets too much of the hash power, you basically get this result of of a Bitcoin miner can mine stacks for virtually free and have a much higher profit margin than other miners, which means that they can effectively mine with only gas and kind of drive out other miners, and it can have an actual unintended effect of actually reducing the total number of miners potentially. It's hard to model that again, right? Because it's hard to model, like extrapolate from data, say what would happen if in this case, but it is a risk that's very worthwhile of keeping in mind. So those were the three schools of thought proposals that I kind of dug into and tried to quantify more to kind of understand like what is the best path forward. My summary, maybe I should have started with this, but my summary overall is that like there are no quick fixes, unfortunately. I think that dust mining can increase the total number of miners, and hopefully some of those convert into full miners. So I think dust mining is a relatively low risk, medium reward-ish type of change, I would say. Potentially, we could also experiment with counting a small portion of gas fees towards VRF relatively safely, as we'll see when we look at the data analysis. However, this might need to be, incorporate other changes. Wanted to get Jude's opinion on this. And in the long run, I continue to think the only like real true fix is non-custodial mining pools. But I think that in the short term, dust mining and maybe experimenting with a very small portion of gas fees counting towards VRF could be paths forward in the short to medium term. So let's just dig into each one of these really briefly to look at the results. So dust mining, I've created reports on all of these. And you can, again, if you go to this mining centralization forum post, this is the most recent post I made. There's links to all these reports, so you can dig into the full report in as much detail as you want. Feel free to ask me questions on the forum or on Twitter or on Discord, but you can dig in for yourself there. I'm not going to go into it in like full detail, and the quantified results are also available there, but we'll just go like really high level. So we've talked about dust mining. The risks are basically, that like maybe if dust mining is actually more profitable than normal mining, you might get normal miners acting like dust miners. So there's a bit of a risk there, like if dust mining isn't actually that well received. But basically we want to just look at given we allocate a certain percentage of stacks activity, stacks blocks that are won to dust miners, what impact will that have on reducing existing stacks miners' profit margins, and what will that lead to in terms of like them leaving potentially, versus how many more dust miners can that attract, right? Because let's assume that dust miners need to at least break even. We can calculate, okay, given we're allocating, for example, 10% of stacks blocks to dust mining, that means there's this much revenue available for dust miners. Assuming they at least need to break even, that means that at most, right, this many dust miners can exist given what gas fees are at a given time. So that's kind of the methodology. And so for the results, we basically looked at three scenarios. So if dust miners were okay with perfectly breaking even, if dust miners were okay with half of other miners' profit margin, so in this case about 5% profit margin, or if dust miners required the same profit margin as other miners were getting, about 11%, what would happen? And you can see that as the number of dust miners increases, all else equal, there is a reduction to the sats available for stackers, because relatively more of stacks mining is going to dust fees rather than to stackers. And so I personally thought that this 30 figure made sense. So if we allocate about 10%, 9 to 10% of all blocks. So essentially, if we just say 1 out of every 10 stacks blocks, rather than being won by VRF miners, is definitively won by dust miners. That would have basically allow for there being about 30 dust miners maximum to mine in these given in these different situations. So whether they're breaking even or making a slight profit. So if we start allocating more, like 12 or 13%, in order to avoid like a greater than 10% reduction to stacking yields, we need to like bump the inflation rate up. And the current inflation rate is about like 3.6-ish% year over year in stacks. And you bump the inflation rate, it starts breaching over 4%. So like it seemed a bit high for me. Like I'd like to all else equal, like keep it, in the same range, like three-ish to 3, no more than 4%. And so 30 allocating about 9 or 10% of activity to dust mining felt like a reasonable compromise, where you're taking a slight hit, 10% hit to stackers and or increasing the inflation rate, but no more than about 0.3% than what it currently is. And you're getting, as an expected benefit, 30 additional miners. Yes, they're not increasing the protection against greater than 50% attack, but these are 30 people who are now mining, learning about mining, passionate about mining, hopefully discussing mining. Hopefully at least a couple of them will convert to full miners over their lifetime. So that's kind of the thought process there. So that's dust mining, and that's why of these 3 proposals is in most kind of bullish or favorable towards dust mining, because it seems like a good balance of like relatively low risk, not the biggest benefit, but some benefit. Let's then talk about the counting gas fee, or no, let's do minimum gas fee as a percent, right? So if I'm bidding 100 sats, I must pay X% gas fees, minimum percent as gas fees. And so how do we analyze this? Well, basically we have to assume that new miners, if new miners would join now, right, they would do so. The only thing that is preventing them from mining is either that that it's too costly to get started, but this doesn't change that at all, or it's too technically challenging or time consuming to get started, but this doesn't change that at all either. So the only thing that would remain that this could change is that there's not enough profit margins available to new miners to join. And that's something that this does change, because, right, the more you're requiring gas fees as a percent of sats, the more you would expect existing miners to reduce their VRF commitments. And therefore, the more profit margin kind of quote unquote room is created for additional miners to join. And so the only kind of way this could possibly attract new miners is by increasing profit margins, because again, it doesn't do anything to decrease the barrier to entry in terms of time or complexity. It doesn't do anything to decrease the barrier in terms of capital requirements to get started. All it does is possibly create new profit margin room. And so if it's going to attract new miners, it must be that there's enough profit margin available for another miner to join in. And so what I did basically was look at miners of different sizes. So like a median sized miner versus a 25th percentile size miner versus a 10th percentile size miner. What would be the profit margin available to them if they were to join the system now? If they were to join the system now before any changes, right? Clearly that profit margin is not high enough for them to join. Otherwise they would do so. They would already have joined. So I look at what is that profit margin? And then if we set a required gas fees, let's say 10% of your bid must be gas fees, what does that reduce other miners' behavior like? And then if I were to now join that theoretical situation, what would my profit margin be then? And how much larger is that profit margin versus the profit margin if I join the system now today as it currently exists? And you can basically calculate how many of a given new miner of a given size can join while still joining at a profit margin that is at least equal to or greater than the current profit margin they could join at. So this is like a best case scenario, like it's a maximum number of expected new miners to join, essentially, calculation. But unfortunately, when we look at the actual, when we run the numbers, when we look at the actual situation, so this is This is miners of a different size, right? So this is people mining like median size. They're spending about 8 Bitcoin per cycle, 6 Bitcoin per cycle, 3 Bitcoin per cycle. So they're getting smaller and smaller miners. And this is the percentage that is required to spend as gas fees. So currently, on average, miners spend 2.14% of their VRF as gas fees. So for every 100 sats they spend on VRF, they spend 2.14 sats on gas fees. And this F percentage is saying, what if we set the minimum to say you are required to pay 10 sats gas fees for every 100 sats you spend on mining? Unfortunately, as we can see, as you set this number, there's not really many additional miners attracted. Like there's never more than one at best additional miner that is attracted. Even when you set this extremely high, like 20% of your VRF has to be gas fees. And there's also no impact, well, that's not really worth noting. But what is worth noting is that there's a change to stacking rewards, right? Because as this number goes up, you have a larger and larger percentage of total sats being spent on mining going to gas fees. And so that means, all else equal, fewer sats going to stackers. And so as you increase this number, you can see that a change to stacking rewards go down and down and down and down further, and you really don't get much of a benefit. You get like maybe attracting another miner, but probably not much of a benefit, and there's a slight hit to stacking rewards, and you kind of complicate the lives of existing miners, require them to pay this fixed percentage of their VRF as gas fees. So probably not the best solution for attracting new miners, although again, it could be a great way to level the playing field of existing small miners versus existing large miners. So the final proposal was counting gas fees towards VRF. So how do we analyze this? Well, I basically iterate through the possible settings of percent of gas fees applied to VRF, as well as for a given percent hash power that a Bitcoin miner has. Because the biggest risk of this approach is that Bitcoin miners can basically exploit it, abuse it. So rather than explicitly model like how many new miners this would attract, because again, there's not really a way to do that in a data-driven way without extrapolating. This analysis was more looking at what is the maximum we could set while still being safe from a quote unquote attack from a Bitcoin miner. And so that gives us just an upper bound. It lets us know like where can we safely explore, where can we safely run an experiment and just see, run the experiment if it's safe to do so and see if there's any realized impact. Because again, I don't think there's a great way to estimate. So I basically looked through if we were to set the percent of gas fees applied to VRF at different settings, 10%, 20%, 30%, 40%, and given a different hash power for the Bitcoin miner, how could they optimize their mining such that they would optimize abusing the system? And so you can imagine the way that mining currently works is that there's like a 6 block look back period. So what do I mean by that? So if you bid on one block, you don't actually get any chance of winning. You need to bid on at least 3 of the 6 blocks because your chance of winning a block is the median of your activity over the last 6 blocks plus your current activity on the latest block. So that look back period of 6 blocks means that a Bitcoin miner who's winning, just to keep the math simple, like let's say a Bitcoin miner literally has 50% of the Bitcoin hash power. Now, yes, this creates many other problems that are much bigger because Bitcoin itself will be attacked, but I'm just trying to keep the math simple. So let's say a Bitcoin miner has 50% of the hash power. They could win 3 out of every 6 blocks, meaning that they could bid literally 0 in 3 of those 6 and then bid a tiny amount in the other 3 so that the median in the block they win is greater than 0. And they can force no one else to be in the block they mine because they're mining it. They can include only their transaction. In that scenario, they can literally mine stacks for free. Now, again, that's 50%. It's a little bit extreme, but the same principle holds. All else equal, as you increase the hash power of the largest Bitcoin miner, the cheaper it gets for them to mine. And so that's the analysis I kind of looked at. So On this tab, you have different look back periods. So what if we made the look back period shorter? What if we made the look back period longer, right? Currently it's 6 blocks. We looked at what if we increase the percent gas fees to VRF? So 10% of them counted to VRF, 20% counted, right? Currently 0% count to VRF. And I looked at the largest miners' hash power. Now, over the last year, it's been about like 25 to 30-ish%. It's pretty typical. This figure here represents the relative amount of stacks per sats Bitcoin miners are earning per normal miners by just sending gas. So when this is less than 1, what it's saying is that a Bitcoin miner who's only sending gas is mining less efficiently than a normal miner. So the Bitcoin miner doesn't actually have an economic incentive to like attack the network by only mining with gas. They would still need to mine some VRF like a normal miner if they wanted to be as profitable. But as they acquire more hash power, or as we increase the amount of gas fees to VRF, you can see that Bitcoin miners actually become more profitable than Stacks miners. And when they acquire enough hash power to effectively win enough of the blocks, this like skyrockets, where they're hundreds or thousands or tens of thousands as times more profitable than other miners, because they can do things like bidding literally 0 sats in a few blocks, then bidding a tiny amount, just enough to have a non-zero balance in other blocks that they lose, and then in blocks they win, they can exclude everybody else's bids and just bid again some tiny non-zero amount and win that entire block. So in the current look back period of 6, like realistically, miners mine 25 to 30%, but if they acquire a third of the hash power, where they're winning 2 out of every 6 blocks, they can effectively run this attack even with just with a very small percent of gas fees going towards VRF. They can mine with only gas fees and thus mine much more profitably than other miners. So that's a little bit too close for comfort, this 35% versus like what the market is currently of the largest miners, 30% for my taste. So I think if we were going to do this, we would need to actually increase the VRF look back period, or do something like, instead of a median, take like a 75th percentile or something like that, some way of making you need to be even more consistent, or at least non-zero. But you can see as we increase the look back period, it reduces the likelihood of this like extreme case of an all-out exploit attack, but it makes it less of an advantage to assign gas fees to VRF before it becomes break even, right? So you see it's like less extremes happen when you increase the look back period, but you get a quicker increase in the miner's competitiveness as you increase gas fees. So realistically, if we wanted to be safe, we'd probably have to be playing in like this arena where we're assigning no more than 10 or 20% to a VRF 10 or 20% of gas fees to VRF commits. And that's after increasing the current VRF look back period to make it more resilient to a large miner acquiring so much hash power that they can just abuse that median rule. And then I also looked at, just for sake of example, 12 blocks, and again, makes it more resilient, but it makes it also miners are easily more profitable on a reasonable scale as you increase percent of gas fees. So this approach, again, doesn't seem like the best. It seems unknown benefits. Likely speaking, even if we did this of count like 10 to 20% of gas fees towards VRF, probably not a huge increase in the number of miners, just that's mostly just my personal opinion, not really any hard data necessarily to say that, but likely probably not that many new miners, and with considerable risk and unknown kind of outcomes. We don't know how to really predict how many new miners will come on, or how to predict what Bitcoin miners might do in response. So it also requires other parameter changes to mining. So again, not probably the best solution, although maybe we could do some experiments with it safely. So that's really everything I had. Happy to dig into questions or anything. I know there's some interesting questions I had about mining, like this running this analysis got me thinking, and Jude recently talked about this on Twitter, like if in the inevitable future, all Bitcoin miners start mining stacks, you would actually expect them to be, as I win a Bitcoin block, I censor everyone else's transactions and I make sure that I only I am mining stacks in that Bitcoin block. So I must win that stacks block. But I do have a question, like, how does that work with the median rule? Because if one miner has a bunch of if miners equally win like 1 out of every 6 blocks, for example, no one would ever have enough blocks won to hit the median and be above 0. So like, I wonder how that works in that case, but kind of getting into another issue. Happy to dig into any questions or continue the conversation on these topics.
Well, I can ask the question just real quick. The solution where you have, if you're so the function is min of last commit and median things. But if that value is 0, we just bump it to 1. Where in this case it's 1 out of 2 to the 256th power chance of winning if you're competing. But of course, if you're not competing, you're the only possible winner. But you do have. Okay. Yeah.
So if you're the only bidder and you're 0, you would like the stack chain would still get mined. It wouldn't be paralyzed.
That's right.
Okay, cool. Thanks. Any questions or thoughts?
Yeah, people just want to unmute and ask the questions.
Yeah, I had a couple in the chat, Maddie. So yeah, it's probably kind of lost here. I know Dan also had one about the 30 dust miners specifically. But my question is really just around, it looks like from the charts that you went through each specific method here.
Yeah.
But I was curious if you did a analysis of the combination of any of the 3 together.
I did not do that. No, I did not do like a little bit of this, a little bit of that analysis. No, because it gets it gets quite complex pretty quickly.
Yeah, I can imagine. Okay, good to know.
I had a related question. I think we all agree this is an important topic, but I think you started off the presentation by saying we know that it's very expensive to be able to mine. I think the same thing holds true for Bitcoin, and yet they have a lot more miners. So have you done an analysis on just waiting? And I say waiting, but as the value of stacks goes up, in theory, we would also be attracting more miners. Have you done any analysis on just what doing nothing would be in at different price points, how many miners we could expect to be profitable and things like that?
Yes, yeah. If you check out the mining report I published, it goes into that. Like, so one of the factors that increases the number of expected miners is indeed the Sats denominated value of the Coinbase reward of the stacks block reward. And so as stacks appreciates in BTC terms, all else equal, yes, you would expect more miners to join. That's in here somewhere. Yeah, that's in here. So you can, if you wanted to, you could read into that.
Thank you. I'll take a look.
I just want to add to that, Dan. Historically, we've seen the number of miners at around 10 is the break-even point, give or take. So, depending on the price point, it can go up or down, and it's constantly adjusting around 10 average as a max.
That's at the current values, right? Or the current trading?
Well, yeah, I haven't checked in a while since, we're in a little bit of a winter, but this is before the winter, is that 10
Yeah.
number.
In the winter, it's looking a little bit lower, more like on the order of 7, but yeah, it's been higher previously for sure.
Yeah, yep.
Yeah, I had a question too. I was wondering with the dust miners, it seems like we're kind of compensating them. We're giving them a lane in which they can work now. Would it make sense later to give them a requirement where they also have to be a part of a mining pool once we have that available? That way you do get some of that VRF. you're not taking away too much from stacking, something like that.
Yeah, I mean, I think the important thing to keep in mind with dust mining is that it doesn't need to be a permanent change necessarily, right? So it could just be a short-term fix or even an experiment only meant to run until something like non-custodial mining pools are available. So it does, we don't need to necessarily keep it, and to some degree, it kind of like acts kind of like a non-custodial mining pool to some degree before they come online, and then it becomes kind of redundant when they are available anyway. So I personally would think it makes sense to like sunset dust mining, even if we do it once pools are available. Jude, I'm curious from your point of view or anybody else. I mean, do you guys agree with kind of my conclusion of like dust mining seems to be a reasonable best option, or any opinions on risk reward trade-offs?
Yeah, I'm sort of kind of digesting it a bit.
Yeah. Okay. Fair.
Another question. Do we have a way of verifying that everyone's using the same mining software? Do we know, I mean, is there, I know this is just based on the fees, but are there ways that somebody might be using a different miner to gain an advantage in this situation?
The short answer is no. I don't. There's, Jude, correct me if I'm wrong here, but we can't actually know or force miners to run like a given version of the software.
Not really.
Yeah.
You can hard fork, but like, they can just refuse.
Yeah. So it is theoretically possible that, Stacks miners who are also Bitcoin miners, for example, are running a version of the mining that like prioritizes in the Bitcoin blocks they win, like only their Stacks bids get through, for example. It's possible that a Bitcoin miner is already doing that. I haven't explicitly like looked for evidence of that happening, but it is a possibility.
Just a question about dust mining. It sounds superficially similar to an idea that's in SIP 001 right now that we ended up not implementing and will likely drop with the subsequent SIP, and that is something called user support burning. The idea behind this is that instead of being a full-fledged miner, you as a user could burn Bitcoin, but in doing so, you signal which block commit in the mempool you are trying to help, such that the Bitcoin you burn goes to the total sortition weight of that block commit. You might imagine that like you could build mining pools on top of this. Like if I'm a miner, I could submit a low value block commit, but you could submit a user burn support with some Bitcoin that collectively increases the chance of the block winning.
So I get like a pro rata share of it winning essentially?
Yeah, that's how that would work.
Yeah, okay.
We ran this past an economic audit though, and the economic auditors had pointed out that no one's going to use this. Because if you could do this, you would simply find a way to do this through a multi-sig system, or you would coordinate with the miner out of band to get transfer Bitcoin for Stacks pro rata. Because the extra transaction fee that you would have to pay through your support burn would cut into your potential profit here. Like obviously there'd be a floor at which it doesn't make sense to do this at all, because if your pro rata share is smaller than your Bitcoin transaction fee, then what's the point?
Yeah, I just want to be clear. Are you saying that the gas fee would count as that kind of support, or I would still need to separately send a VRF-esque commitment to support the original contribution?
No, the gas fee is separate. The Bitcoin transaction fee goes to the Bitcoin miners. You additionally burn some Bitcoin, and that burnt amount is what gets contributed.
Gotcha. Okay, so I think the key difference between that and dust mining is that in dust mining, the gas you're sending, that gas sats you're sending, is what gets you a chance of winning the block in this prefixed byte claim, right? Which like limits the scope of risk, and therefore it reduces the capital. It greatly reduces the capital requirements to get started mining, which it sounds like was exactly the issue with the other proposal, that it didn't do that.
Right. I mean, you're still paying a transaction fee. every time you send a dust mining transaction.
Yes. Yeah,
and
but you have a,
like 5,500 sats or something like that.
yeah, but you would at least have a fixed like known kind of reward for that, where you can realistically, or at least more realistically, break even than right now. Like if you're bidding, you need to basically bid, last I looked at it, you need to bid enough that your gas fee is 17% or less of your VRF commitment. Otherwise, there's like absolutely no chance you'll be making a profit or breaking even. So this lets you do that. It's like only sending a very small gas fee and having some share of revenue.
Remind me again, the probability of winning if you're a dust miner is like 10% or something like that. Like one in 10 will be won by a dust miner.
Basically, the concept is like a fixed percentage of blocks are won by that bike lane, like by any or all dust miners, and then like dust mining itself would be some kind of like pro rata pool of that fixed allocation.
Sure. The question I'm ultimately kind of leading up to is like, what is the is there a world in which it's profitable for normal miners to also be dust miners? And
yes.
That
So
might actually be the biggest problem, I think, because if
Right.
if dust mining is dominated by just Bitcoin miners, then all you've done is really just you've kind of made like a more convoluted version of making the transaction fee count.
Yes, so I agree with that. The two caveats I would say are, one, unlike making the transaction fee count, this limits the scope of risk a bit more to a known kind of vector of attack. And two, dust mining, it is profitable for VRF miners to act like dust miners if and when dust mining is more profitable than VRF mining. So let's say that dust mining launches, it's more profitable. All the VRF miners instantly become dust miners, like take up all that. You would imagine, like practically speaking, because the capital requirements to dust mining are so much lower, there are probably some people who are willing to mine at that small size for at least a slightly smaller profit margin than existing VRF miners are looking for. And so even if just one or two dust miners come in with a lower profit margin, that reduces the profit margin of dust mining below that of VRF miners. So they would be, all else equal, start to leave. And if you had enough kind of like altruistic dust miners who were like smaller participants who are like interested in learning about mining, less profit motivated, maybe they want to just support the system, that could actually result in the dust mining profit margin dropping to below, even dropping to zero, just break even, where the VRF miners do not have any incentive any longer to act like dust miners.
Yeah, that all makes sense. I'm also just trying to think like there's one other barrier to adoption that I don't think was addressed here is there's going to be some variance in the profits even in the very short term, because first of all, the Bitcoin mempool is variable sized, so the transaction fee you're paying as a dust miner is going to fluctuate up and down with market demand for Bitcoin, and that's also a fluctuation in terms of real dollars. The other concern is that if there's enough participation, then you might find it to be the case that Bitcoin blocks simply can't hold enough dust miners. Like there will be dust miners who will be left out because they're not paying a high enough transaction fee. But I guess that's really just a manifestation of the problem of what you just described. Like the result is dust mining becomes less profitable in VRF mining.
Yeah, that's why I did the analysis structure like I did. Like if you set on average, right, if you set like 10% of blocks to be won for dust miners, given what gas fees are, and assuming some kind of acceptable profit margin, like even all the way down to 0%, breaking even, like only 30%, only 30 dust miners could mine at a break even. If more miners come in than that, they would start making a loss. And so like it's unlikely that you would get like hundreds of miners coming in, which again, yeah, I agree with you, would create a different problem of like clogging Bitcoin itself.
Do you what was new to me in the description here was you were saying that dust miners would receive a pro rata share of the block that the winner won, as opposed to one just taking the entire block reward?
Yeah.
Does it matter which of those two things happen? I think in the long term, it shouldn't matter. Like your odds of winning are because it would even out, but in the short term, the variance might get participation.
Yeah, it's a variance thing, I think, because especially when you're talking about these small of numbers and it's like 30 of different individuals with these small of numbers, like, it's going to be it's more a variance smoothing thing. So I don't know, in practical terms, maybe it doesn't need to be pro rata, but that's the thinking, at least to better align the like random participants realized outcome with their expected long-term outcome.
Mm-hmm.
But I can see it working both ways potentially. I mean, this is more analysis, more to see like if it was what impact would have, is it even viable necessarily, than like looking at how it should be implemented.
Yeah, this is like more of a product, like a product design decision.
Yeah,
your revenue stream is going to be the same over the long term either way.
Yeah.
Can Bitcoin miners be dust miners?
Bitcoin miner, best dust miner. I think it's the same thing as like current. I don't think it introduces any new attack vector that isn't already present, or like, and it's not even necessarily an attack vector. Like if Bitcoin miners become stacks miners, right? Like that's a good thing. We just don't want them to be able to be the only miners per se until that time. But I don't see how dust mining would enable any new.
Well, one thing that might, depending on how it was built, like one thing that dust mining does do is it creates a very low barrier to entry also for Bitcoin miners who want to try out being stacks miners.
Yeah.
Like they don't even have to do funny things with their mining software to filter out other block commits. They could just send their own at this point.
Right.
And for a minimal amount. That, for better or worse, like that might get them more interested in mining stacks. Depending also on how this works, like if like a dust miner also has the ability to potentially cheat, right? Like because they could just look at the mempool and pick out the block hash of a block commit in the mempool already and just make a transaction with that block commit in it without even validating the block.
Well,
I guess
achieve or I'm not quite following.
They would eventually need to get that block somehow. But actually, yeah, I guess I'm thinking of like the way that the miner currently behaves. I think the miner would still send the block if it saw that block hash won, but that could be turned off pretty easily, and that would make cheating basically impossible. I'm just thinking like, could somebody do this in a way that allow them to not run a stacks node, which is also a barrier to entry.
Gotcha.
And if the answer, I want the answer to that to be no in the system design. They have to.
Yeah. Right. Yeah, I think in my mind, the biggest benefit of dust mining is not per se just like increasing the total number of miners. It's increasing the total number of people who are like actively mining and may become, more engaged and more committed and larger miners in the future. Like that to me seems like the real benefit, functioning as this like on-ramp or this tutorial almost.
Yeah, that all makes sense to me. I'm also just trying to think like well, I definitely buy your argument that this is like a very low risk way to do that. It's also a very resource intensive way to do it because it requires doing a hard fork to introduce. And I'm just trying to think like that the way what you just said kind of is an interesting framing. If the goal ultimately is to just provide a better on ramp, I almost wonder if this problem can be addressed by simply making a node runner service where you would just pay somebody else to run the miner for you. I guess like the question then becomes like, are we trying to make it so people want to run miners at home or on machines that control?
Yeah,
I'm thinking out loud here. I'm not trying to be prescriptive or anything.
Yeah. Follow you.
do you think there's enough here to work with, or what do you think the next steps could be from today? Or do you think we need like another session of getting the brains together, hash things out?
Let me think. I mean, I feel like we've done a pretty good job. Maddie has really done a really good job analyzing everything. I think maybe the next step here could be, I know that dust mining was an idea that came from Munib, so maybe he or someone at Trust Machines could send over a SIP that kind of fleshes out the proposal with the parameters chosen.
Yeah, I think I would want, you know, Munib and especially and at least to hear Ryan's kind of opinion, because he was one of the most active, most vocal people in the thread. But I agree with Jude by and large. Like I think probably diminishing returns are at the point of like not much further to do other than get specific about a certain proposal and just more like yay or nay type discussions rather than what if type of discussions.
Yeah. So maybe I'll nudge Ryan on this proposal, and maybe see if he can chime in on the Stacks forum.
Okay, yeah, I think that'd be helpful. And then also, yeah, definitely like from the Trust Machine side or from Munib, since dust mining was more the originally Trust Machines concept.
Hold on, Stacks, do you want to mention your question?
Yeah, I was just curious if, you know, we're kind of giving out a subsidy for dust mining to include new folks into the process, right? So if Stacks price were to appreciate in terms of Stacks, the dollar denominated amount, would that be a very large subsidy at that point then? Just to sum it up,
Yeah, sorry, go ahead.
is it linear in terms of the amount of dust to the, like, if Stacks were to appreciate the mining activity?
Well, I mean, it's more a function of the Stacks reward, the value of the Stacks reward compared to what Bitcoin gas, Bitcoin transactions require for gas fees. And like over time, gas fees have been dropping. So let's just assume that trend continues or stays the same. Like if Stacks increases in value and or gas fees decrease in value, what that means is that enables all else equal more dust miners to join at a given profit margin. So if Stacks appreciated, I would expect basically more dust miners to be able to join. Now, this does raise the potential risk of, like, let's say Stacks, wildly appreciates, and now there are like hundreds of dust miners. That probably means that we need if this were implemented, we need to be able to tweak that percent of blocks that are going to dust mining via some kind of mechanism, ideally that doesn't require, an entire hard fork. But that is a risk. I don't think it's like I don't see that as like a large short-term risk, but it is something to keep in mind.
Okay, thank you.
Cool. So yeah, so we're a little bit over time. So maybe I'll just, unless anybody got anything else, or we will try to close out here. Cool.
Well, I did have one last small thing. If we were to go ahead, we being the community, to go ahead with the dust mining SIP, one thing I would hope that the SIP authors would address is what, if anything, they would intend to do about the resulting reduction in the expected POX rewards. Maybe, for example, we could increase the length of a reward cycle by 10%, so that that would make adopting the SIP more palatable to the majority of stackers.
Interesting. Yeah. Yeah, I think one other possibility is kind of shifting the emission schedule, the kind of inflation schedule stacks to the left, so that more are like the total number of stacks doesn't change, the total max supply doesn't change, but relatively more are emitted earlier and relatively less are emitted later on the curve, when presumably things like non-custodial mining pools will be available. So that's one example. That's one possibility. Also, a possibility of increasing the cycle time, so that obviously like doesn't really help in APY terms, doesn't really help reduce the impact, because you're increasing the length of time per cycle.
Yeah, I was just trying to think like, I don't know, like I know that Trust Machines had this other RFC where they were proposing altering the inflation schedule. Left, like you had said, and it didn't really go anywhere, in part because it was such a unpalatable idea.
Yeah. Well, that's why there's also like a piece of the analysis I looked at of like, if you did shift the inflation, like how much would you need to shift it in order to offset the reduction of dust mining? And you'd only need to increase the inflation rate like 0.2% from what it is currently for 30 new dust miners. So I think it's like still not the best, but like not that outrageous. And again, it still wouldn't change the total max supply of stacks. But yeah, those are definitely open questions that also need discussion.
Right, and this also like would only be a temporary thing. Like the dust mining would be phased out either through an on-chain vote or through a subsequent hard fork or something like that.
Right.
Would the launch of this SIP say, would it make any difference if you propose this after stack 2.1?
Well, it's going to happen after 2.1. We're nearing code completion for 2.1 right now.
Right. Okay. Cool. Right. So it's going to be a hard fork, and we need some tweaking to the tokenomics.
Some things are going to need to be tweaked. We'll also need to test it pretty rigorously.
Cool.
Yeah.
All right. Okay. Right. Okay. So maybe I'll just be mindful of everybody's time. So maybe I'll try to close out here. So maybe if Maddie can stop sharing your screen.
Sure.
All these will be linked in a video, so everybody at home can watch back. So just to touch up. Right. So I'll probably skip this open discussion, but people feel free to like nudge me or any concern they have about anything they want to discuss. We can bring it up in the future or in DM. I'll skip this too, but things that you can get involved in, going on Stacks forum, exactly commenting on these kind of stuff. Whatever you're hearing today, you can feel free to log your comments and different ways to get involved, like GitHub, CAP, SIP editor. So yeah, please let me know. And this just a little advertising for the CAP members. So I'm looking for CAP right now. So if you want to join one of these panels of please let me know. And this is all the people we have. We have 20 individuals already. So actually everything is everything's ready. But we, if you're interested, please, we can have 4 or 5 people per panel. The more people, sometimes other people might be busy, so maybe it's good to have more people in case people are busy doing other stuff. So yeah, if you're interested, please let me know. We have all the best people here. Yeah, so I'm just looking for all the people, the best people in Stacks. So please join. And there's a blog about how to get started to become a CAP member. So I'll post a link in the meeting notes and stuff like that. So yeah, thanks everybody for everybody's time. So yeah, that's it. Yeah.
Thanks, guys. Thanks, Hiro.
Thanks, everyone.
Thank you, everyone.
Thanks, Hiro.
Thank you.
Thanks, Hero. Great job, man.
Thank you, man.
Yeah, thank you.
Add,
Hero.
add it to your calendar. So it's in your calendar, you can see it. Yeah, bye.